Hello everyone and welcome to my channel Beat the Denominator. So in today's video I want to talk about the real estate market and specifically why I don't think it can drop much in 2022-2023 and going forward. And I make this video because there's been a lot of chatter about whether the real estate market will crash or not, as mortgages have been rumored to perhaps near 8% on a 30-year within the coming months. I don't think that's going to happen. I don't think real estate is going to crash. And first, let me walk you through a little introduction as to why I don't think that. So why do we talk about the real estate market so much? Well, it's because real estate has grown 45% in 2.5 years. That's about 18% annualized, and that's between 2020 and 2022. So it has run so high. And a lot of people are saying, well, wait a minute, it has to go back down. It will go back down. And in fact, if you look at the past few months of a Case-Shiller index, which is an index that studies real estate prices in the 20 largest cities in America, it has gone down 0.75% month over month. So not much of a slowdown, perhaps just a little bit. But I think real estate has grown so high because of monetary mass, because there is so much more money in the system than there used to be 2 years ago. And in fact, money stock went from 15.5 trillion to 21.7 trillion. That's a 40% increase in the money stock in 2.5 years. So when we compare the 40% increase in money and the 45% increase in real estate, we realize that the two numbers are just about the same. 18% for real estate, 16% for money. So is real estate really going up because we have quantitative easing? And will real estate start dropping because of quantitative tightening? Well, let us see that. But before, let us look what the effect of the hikes, what has been the effect of the rate hikes. And as we can see, this effect has been very minimal. We've had a multiple fold increase in the Fed's interest rates, 25 basis points in March, then 75, 75, 75 three times, and we're about to get a fourth 75 rate hike perhaps in November, and maybe one point in 25%, 25 points in December. So we've had all these crazy rate hikes, and what we look is that really we've barely stopped money growth. We've just stopped the growth of money stock. If you think real estate is going to go down, you have to make the assumption that we're going to reduce the number of dollars outstanding. And in many of videos of this channel, I will explain why I don't think it's possible for this to reduce. I don't think they will reduce it. I think the best they will do with this economic crisis that we're entering, the best they will do is keep it flat, which is why I don't think real estate will go down. But let's dig a little deeper. We see a lot of this chart on the internet. So this chart on the internet shows people buying a house in September 2021. You had a 30-year fixed at 2.8, 2.9% for a 30-year. Average home price $271,000. Your monthly payment is $1,100. And nowadays, as of a month ago, the mortgage interest rate for 30 years is almost 7%. The price has risen to $307,000, and the monthly payment is $20,000. So we see these scary numbers, and people tell you, well, of course these prices have to drop because home affordability has taken such a big hit. And so when you see this, you're like, well, everything's gonna drop. Sounds very dire, right? Well, not so fast. First of all, in these analyses, I never ever see people talk about the third of the mortgage payment, which is not related to interest rates, which has increased, but does not have increased nearly as high. The monthly cost with interest rate has doubled, but not if you take into account the third of the most mortgage payment that is not interest. And then buyers are reactive. People are making the assumption that that buyers are not going to change their habits when they see interest rate in the 7%. But the truth is that they are going to change their habits. We've seen that the adjustable rate mortgages have been on the rise. And I understand why. It's a very smart bet. If you take a 7-year or a 10-year ARM mortgage and you refinance as soon as the rates drop, it's a good gamble to make. And a lot of people are deciding to go towards these arms. A lot of people were planning on doing a 20% down payment, and then they realized, well, let me do a 3% down payment, and that way I'm hoping that my raises down the road, the cash I've saved plus my raises, will be able to help me to make that extra payment. That's something that they do. We see huge incentives from builders, from mortgage lenders to try to drop those rates. There's a lot of incentives happening right now. So again, many are factoring future raises in their buy decision as well. They probably have jobs buyers, and they're probably doing very well with their jobs. And with inflation, raises are going to go up. Again, another assumption is that people are going to lose their jobs. But there is a strong job market. And I believe the job market is driven by innovation, technological innovation. That's what the job market is driven by. It's not necessarily driven by the Fed. Just because the Fed removes money out of a system does not necessarily mean that economic growth will abate. And we've seen over the past 7 months, the Fed has had a hard time slowing down economic growth. That's why we do this 75 basis points. The reason why we have all of these advantages as well is because we're entering a deflationary phase of the economy. We're all going to be able to save money. For example, electric vehicles is one example of that. If you buy an electric car, your household can save maybe $6,000 or $7,000 worth of gas each year. That's a future cost savings, and we're entering a deflationary world where people are going to have more and more available income. So let me move on. What is another reason why I don't think real estate will drop? Well, real estate is viewed by most Americans as an investment. In fact, it is the biggest investment of most Americans. It is most of Americans' net worth. There's a lot of advantages to real estate, right? Most of the time, it's a leveraged, deep appreciating asset, right? Because you take a mortgage to leverage yourself. It's a forced savings account, especially if you take a mortgage payment that is a little higher than what you would normally save. You can use it as a line of credit. It's an entrepreneurial investment if you are trying to renovate it. So Americans love real estate because it is this investment that has all of this optionality that other investments may not have. So Americans may be willing to pay more for their real estate because of the value of this investment. Another big advantage of real estate, and specifically single-family homes, is that they are a true hard asset. Supply is very low, and building a house is much harder than increasing monetary printing, right? You need land that's limited, material, labor, and time. These are all rare resources that are very limited. And thanks to that, we see a very small growth in the supply of single-family homes. In fact, in 2020, you had 83.4 million single-family homes, and it only moved in 2022 to 84.28 million single-family homes in the United States. So it's a very small increase. It's a 0.98 increase in 2 years, which was about 0.5% a year. We can only grow the supply of homes in the United States by 0.5% a year with all the might of the US economy. So you can see how you are not going to see a lot of homes printed really quickly. But let's compare that to the US dollar. Right, the US dollar. At which speed have they been printing the US dollar? Well, as we saw in that chart, about 18% a year has been the growth of the US dollar. Sorry, 16% a year has been the growth of the US dollar. So 16% a year has been the growth of the US dollar. 18% was single family homes by how much they raised. So there's been an increase in dollars by 16% a year. The denominator has increased by 16% a year. And there's been an increase in homes, in single family homes, by 0.5% a year. So what do we see over a 10-year period in this chart that I've put together? Well, in a 10-year period, what you can say is that in 2032, there will be about 5% more single-family homes in this country than there are today. It's very slow to build homes. But if they keep printing money at this rate, there will be 341% more dollars in 2032. So, of course, you get diluted as part of the as far as the share of single-family homes of the country that you own, you get a small dilution of 5%, but you get a much bigger dilution in the US dollar. And so when we go through this calculation, you see that it's not crazy to think that in 2032, with the denominator expanding so fast, single family homes could actually be worth $1.2 million. That is my back of the napkin estimate. So I am very confident that real estate is not going to go down. I do not believe that. They cannot print homes as fast as they can print US dollars, and as fast as we will certainly print US dollars because of all of the deficits that we have. So some think real estate will crash, but I don't think so. I don't think Americans will rush to sell their homes. First of all, let's walk back to the idea that the home is an investment. Most Americans, I've seen their largest asset increase by 45% in value in the past 2 years. They love that. They know it's a great investment. Why would they want to sell that investment? Especially, everybody has a Zillow account today. Everybody has a Redfin and sees the price of their house online. And you can see that it's much less stressful, much less volatile than the stock market, which a lot of families really enjoy, right? The stock market is not a game for everyone. It's very volatile. Real estate is very stable. So for most families, it's a great investment. So that's one of the reasons why I think Americans will want to hold on to their investment. Another reason is many people, and this is a Silicon Valley term, but many people are honey trapped. So what does that mean to be honey trapped? Well, if you have a home that you bought in 2021 or 2020 and you have a 2.9%, sometimes 2.7% mortgage for a 30-year, are you really going to sell that home and lose that mortgage to switch into a new mortgage that is going to be 7%? Or 8.5%, I don't think you're going to list that home unless you really, really, really have to. And therefore, there won't be a major supply of homes in the market. Another one, employment is plentiful. Raises are very high this year. The Fed has been trying to create unemployment for the past 7 or 8 months. And it's not working. And the reason why I think it's not working is because most of the economy that we have, we owe to productivity gains from technology. We owe it to innovation. We don't necessarily owe it to the growth of the money supply. The growth of money supply has inflated assets, perhaps, but companies innovate, right? And they're able to create so many goods and services much faster than ever before. So that's why I think employment will remain high. Moving on, foreclosures, they're still at an all-time low. Banks still work with people who cannot afford to pay their loans, right? Banks are wary about evicting people. There's very, very little foreclosures, right? And so if you don't have foreclosures, well, it may take years for you to walk away from your home. So that's why I don't think we're going to have a 2008 situation crisis, because if you look at foreclosures, if you look at the lending process that banks have applied, banks have been so much more stringent at lending money, and we are not seeing a major or significant spike in foreclosures. Just a little bit perhaps, but nothing major. And then lastly, will the supply keep increasing? Well, again, I don't think so. If you look at all of the builders are cooling off their new construction. They are finishing up the houses that they have, and they are waiting to see what's going to happen. So again, I think the builders are going to take it easy and not put as many homes on the market as many people were thinking in 2020 and 2021 when monetary printing was still very, very strong. I don't think they're going to put as many homes on the market if people can't afford to buy these new homes. So in conclusion, I think real estate, as long as we are in this phase of the economy where the Fed keeps raising rates, I think the prices will stay very stable. Maybe they will drop 2%, 5% in 2023 max. I do not see people rushing to sell their homes. American families know how good of an investment this is, and they have seen monetary printing. They understand why it's so important. And as you saw my estimate, 10 years from now, average single family home in one of the 20 of American biggest cities, $1.2 to $1.3 million. That's a simple estimate, but that's what will happen if the Fed keeps printing money as fast as they have in the past, if they keep quantitative easing, which is one of the main thesis of this channel, is that they will keep. That's why I named the channel Beat the Denominator. That's the main thesis. So thank you so much for watching the first episode of my real estate series. I intend to make many more episodes over the coming weeks. And I plan posting also videos on other topics such as Bitcoin, such as technology, and etc. etc. Don't forget to like and subscribe. I hope you like the new format of the video, and thank you so much for watching.